Okay, so if you're a trader, you've probably used or at least heard of standard pivot points. But what if I told you that's just scratching the surface? Today, we're going to dive deep into three other powerful ways to calculate these crucial trading levels.
So let me just ask you straight up. Do you really think the standard pivot point is the only way to trade? Because if you do, you might be leaving some serious information on the table.
And this is just a brilliant way to think about it. The source material puts it perfectly. Saying the standard pivot is the only pivot is kind of like saying BTS is the only K-pop group. I mean, come on. The point is, there's a whole world of variations out there that traders have cooked up to try and get an edge.
All right, first up, let's talk about the Woody pivot point. Its entire philosophy, its whole reason for being, revolves around giving more weight to a very specific price.
Now, this is where it gets really interesting. Take a look at these formulas. You see the calculation for the pivot point, or PP? It's the high plus the low plus, get this, 2 times the close, all divided by 4. That 2C right there, that's the secret sauce. It's designed to heavily emphasize the previous period's closing price. So what does this all mean in practice? Well, Woody pivots are really for traders who believe the closing price is the single most significant price of the day. They see it as the final word, the definitive statement on where the battle between buyers and sellers ended. And this can be especially useful in a trending market where that close often signals the dominant feeling heading into the next session.
And here, you can see it playing out on a chart. The solid lines are the Woody levels. Notice how the price comes down and finds support right around that central Woody PP line before it continues its fall. For traders using this method, these specific levels become absolute key areas to watch for potential reversals or continuations.
Okay, let's move on to our next variation, the Camarilla pivot point. Now, this one is built for a very specific type of trader, a trader who absolutely loves the concept of mean reversion.
So the formulas here, yeah, they look a bit more complex. That's because they're actually generating 8 different levels, for support and for resistance. Each one uses the previous day's close and its range, but it's multiplied by a very specific number to create this tighter cluster of levels right around the price action. But the core idea is actually simple, and it's really powerful. Camarilla pivots work on the theory that price has this natural tendency to want to snap back to its average. In this case, that average is the previous day's close. This is a potential game changer for traders in ranging or choppy markets, because these levels are basically designed to pinpoint when the price has moved too far, too fast, and might be ready to snap back. And this leads to a very clear, actionable trading strategy. The general idea is to watch those third levels, R3 and S3. When price gets to these zones, you start looking for a reversal trade, maybe selling at R3 or buying at S3. But, and this is a huge but, if the price smashes right through the fourth levels, R4 or S4, that signals a really strong breakout, and it might be time to switch gears and trade with the trend. And looking at this chart, you can really see that mean reversion idea in action. The Camarilla levels are way closer together than other pivot types, almost hugging the price. See how the price tests and respects those S3 and R3 levels? That's the method in practice, designed specifically to help you catch those potential reversal trades. Okay, for our third and final alternative, we're bringing in one of the most famous, almost legendary concepts in all of trading, the Fibonacci pivot point. So this method actually starts with a standard pivot point calculation. Nothing fancy there. But then, to find the support and resistance levels, it takes the previous day's range, that's just the high minus the low, and multiplies it by key Fibonacci ratios, like 0.382 and 0.618, before adding or subtracting it from the main pivot. So, what's the logic here? Well, it all comes down to market psychology. You have countless traders all over the globe who are already watching Fibonacci levels for retracements and extensions. So by baking those ratios right into the pivot points, these levels can become incredibly powerful, self-fulfilling prophecies. And on the chart, you can see how this creates yet another unique map of the market. These Fibonacci-derived support and resistance levels give traders who already use Fibs in their analysis a way to integrate that same thinking directly into their daily pivot strategy. It's pretty cool. Okay, so we've gone through the Woody, the Camarilla, and the Fibonacci pivots. And all of this naturally leads us to the most important question of all. I mean, after seeing all three, you have to be asking yourself, all right, so which one is the holy grail? Which one is the best method? And you know what? The source material gives us the most honest, direct answer possible. The truth is, there is no single best method. There's no magic formula that's going to work perfectly every single time. The real key is to match the tool to your personal trading style. So, to recap, Buddies is for those who put the most stock in the closing price. Camarilla is for all the mean reversion traders out there. And Fibonacci, well, that's for those who believe in the power of the golden ratio in the markets.
Ultimately, you have to remember that each of these is just one tool in a big toolbox. Their real power comes from how you combine them with your overall strategy, with your other indicators, and with your understanding of the market's behavior. None of them are a complete system all by themselves. So now you know there's more to pivots than just the standard calculation. The only question left is, which of these philosophies aligns with your trading style, and which one are you going to start testing in your own analysis?